All right, Yield Nerds episode 185. That is me masterfully navigating this volatility storm in Q1 2026 while the sharks are eating every other investor. I want to share how I'm doing it. Most of the time it is sheer luck, but I will tell you what is happening and how I'm dealing with it and would love to learn from you as well. Well, a couple of quick things. We are at 496 subscribers. Thank you for your support. There are several playlists, and if you're new to this channel, please use the roadmap and a couple of the others with preferreds. And there is a thing called Yield Super Bowl, which is a pre-tax view, which many investment sites don't talk about. So I always look at it from my perspective to equalize them. You may want to check it out. Most importantly, please know that I could be wrong here, and I'm depending on you to do your own checking. And if you find inaccuracies, I would love to learn about that as well. Well, let me tell you how I am dealing with this volatile market while I wade with my sack of money. My portfolio is slowly increasing in the allocation to equity. I am now into double digits. Finally, I woke up and crossed the 10% mark just a couple of minutes ago. Over the last year, I have practically quadrupled my allocation to equities as the fixed income returns have decreased. I kind of came here to look for returns. And so the question is, how did I decide what to buy? I use an algorithm. The algorithm is open source. And, it literally tries to sniff out the MACD signal reversal. But just because the MACD signal reversed doesn't mean I immediately buy. The algorithm also looks for 3 repeated days of stock appreciation. And if that happens, it says, hey, you may want to look at this. I then do my own research on that. And if I'm more than 20% down, I sell. But so far, it has worked out very well. That is my allocation strategy for stocks. It naturally leads me to various sectors. I don't bias it one way or the other. Some of them are because of dividends, others are because of macroeconomics. Industrials are hot right now. IT is evaporating, as you may have noticed. But these are all things where momentum leads me to where it goes. I'm over allocated in healthcare specifically because there is momentum there. So, how am I doing compared to the NASDAQ and the Russell? Check it out. The last 3 months, or sorry, year to date rather, January 1st to now, my year-to-date returns are 11.34%. The NASDAQ is negative, and I'm double that of Russell. So go figure. You can indeed see that I also have downturns. It's just that my downturns are softer than what the other indices experience. But on the other direction, my upward trajectory is steeper. And that at least is what appears to be happening. And I'm very thankful that I have that. And I'll tell you how I do that. Well, that's on 10% of my portfolio, but 90% of my portfolio is on fixed income. And there I'm very conservative. I look for income, and I'll tell you how I do it. And before I go further, I need to once again make it clear that what I'm telling you is not investment advice. It is not tax advice. I am not a wealth management advisor. I don't do product or politics, and I don't have any t-shirts to sell. So what is my bond strategy? I quite simply try to outdo the 10-year treasury on a tax smart basis, meaning if I need to buy a corporate bond, it needs to pay more than the state tax of whatever the equivalent treasury pays. If I want to buy a muni bond, I adjust that as well. So where that leaves me is I don't even look at corp bonds below 4.7%. And if the yield to maturity is less than 5.6%, I just throw them off. Now, even with this, I only look at A-rated corporate bonds. So if you find a triple B that pays 6%, you do you, I don't buy it. I also don't buy anything above par to avoid call risks. And let me be very simple. The last 2+ months, I have not bought a single corporate bond because nothing meets this criteria. What about munis? I do buy munis now and then, but I again have my own criteria. If you want me to buy a 10-year muni, I want it to be 4.25% coupon or more. If you want me to go north of 10 years, then I'm looking for 5% coupon or more. I also do not buy above par, and munis also frequently don't meet this criteria, so I just sit by the side and don't move at all. I'm a patient investor in that way. So what does it mean? When I buy munis at coupons well above treasuries, so for example, a 10-year treasury currently pays give or take 4.2%. If I buy a 10-year muni at 4.25%, that's federal tax exempt. So I get a really nice kicker. And if I buy them below par, not only do I get the coupon federal tax free, but I also get the gain from that 99.5 to 100 tax free, if indeed there is an OID left. If these terms don't really make sense to you, please look for the playlist that says Muni, and you will understand what OID means. What does it mean to buy something that has an unaccumulated OID? So those are very important concepts. Well, what's happening in the market? What's happening to me? I had, as you know, a very large, mostly fixed income portfolio. Look at what happened to me every time one of my short-term treasuries mature. My reinvestment opportunity is horrible because the short-term rates, this is from 2023 to today, short-term rates have just torpedoed down. And because short-term rates have torpedoed down, let's put it in a very simple number. In 2023, you could get 5.5% for the 3 month. That's a shocker. Today, you can barely clear 3.6%. So if you put it in a different way, my income was down 30% on the short-term treasuries because it went from 5.2 or 5.5 to 3.6. So what is my only option? I have to increase duration, go to riskier, securities, and that is what I have been doing, but I'm doing it in a more measured basis. And then I'm going to equities to give me that yield. If you just look at this picture, you can see that sure, the short term is plunging down towards earth, but the long term, after the initial drop, it's gently rising. And that is the classic bear steepening, as they call it. And what do you do in such a situation? You don't keep a lot of short term. You probably shouldn't keep a lot. Well, I don't keep a lot of long term treasuries either. So I need to think through, if I don't want to keep long term treasuries and I don't want to keep short term treasuries, where do I put the money? Well, Yield Super Bowl is where I neutralize the tax advantages. So if it is a muni, which is federal tax free, I bump it up by my federal tax. If it is a treasury, I bump it up by the state tax. And if it is a corporate bond, then I leave it alone because it's taxable at every which way. There are a couple of nuances, and I don't want to go through all of them. You will have to listen to Yield Super Bowl and understand. I will tell you, as I told you, I think differently. I don't use the marginal tax rate, which many, many people tend to use. I use the effective tax rate for the simple reason that people can always argue that your muni income is the last dollar it is taxed at the highest amount. I refuse to accept that. To me, the muni dollar is the same as any other dollar I have because I am a pure income investor. It's not like I have this other salary or consulting revenue that is meaningful enough that the muni income is the gravy. So having said that, you do your own world. So to me, munis, if they are at the right amount, are very attractive. And looking right here, hey, if I can get 5.5, 6% on a muni, I would buy them all day. And so then you have to sit there and go, what are these munis and why are they giving a disproportionate, return? Here is just the muni curve. And as you can see, the muni curve is not inverted. It kind of has that trajectory where you get to make more returns as you increase the duration, which is what a normal yield curve would do. And you want to investigate, and this is again before the tax adjustment. And so whatever your marginal tax rate is, 4 point something percent divided by 1 minus your effective tax rate is how Yield Super Bowl would be played in this scenario. It's very attractive to sit here and say, gee, I should probably buy 3-year munis and 10-year munis. I can live like a king. But when you investigate the 3-year munis, there is a little gotcha. What is that gotcha? Most of them trade above par. Guess why they trade above par? Because they pay a coupon of 5%. So you can sit here and say, wow, pardon me, 5% coupon, I can get that federal tax free. Yes, you're right, except you're going to be paying $101 for $100 in order to get that. And lo and behold, if that muni gets called, you are screwed. Your yield to worst will crash and burn. And that is why I don't buy munis above par. Then you can say, oh, okay, well, I thought the reason the muni yield was very high was because, I could get an advantage, but it doesn't look like an advantage. It comes at a disadvantage of paying greater than par and taking a huge risk of, yield to worst, if it is called, getting crushed. Then you can say, gee, I wonder, maybe I will optimize yield to worst. What if I said, I just want the highest yield to worst, so I'm, quote, guaranteed on the muni a good return? Well, let's optimize for yield to worst. Here I sorted the same returns on Schwab by yield to worst, and it looks like I can make a yield to worst of 4%. And just when I got ready to celebrate, we have a problem. What is the problem? The coupon is only 2%. What does that mean? It's only the 2% that is federal tax free. Everything from that 2% to 4%. So half your income is ordinary income, even though you bought this muni. Well, that defeats the purpose of buying the muni. That is why, in my humble opinion, munis, especially at those two access points, the 3-year and the 10-year, munis are not a good deal. You have to use a filter that gives you about treasury yield to worst and the coupon that is mostly federal tax free. That's how I think, and you do you. So where is my only refuge? My refuge at the moment is agency bonds. They don't have a lot of volume, so you should be prepared to hold them to maturity. But if they give me a really big yield, I will keep buying them all the time. My stocks are at 10%, and my muni bonds are now almost a quarter. But here is where my magic is happening. I went from roughly 8% or 7% agency bonds to almost 24% agency bonds. As the short-term treasuries drop, I am running to agency bonds because these are all callable. They use what's called a Bermuda call, meaning every 3 months they can be called. And sometimes with a 10-day notice, they can be called continuously. And because they can be called continuously, if indeed the short-term rates keep dropping, the odds of these staying on invested are very low. So I buy 10-year, 20-year agency bonds knowing fully well that the odds of them hanging out are very low, which is fine. At least I get to make the high yield interim. So yes, my duration is increasing. However, a lot of it are Bermuda call agency bonds that are state tax free, and that is how I'm playing my fixed income. What am I doing with the equity market volatility? I will tell you. And before I tell you, one of the things I kept hitting is as I move from treasuries, which pay give or take 3.6% state tax free, and I move to agency bonds, remember FFCB and FHLB are the only two agency bonds that are state tax free. FHLMC or FNMA, those are not state tax free. So as I move from 3.6% to 5% in yield, so treasury to agency bond, I expected on Schwab, there is a report called investment income. I expected my income to jump very nicely. And yet I found a quote bug. And I'll tell you what the quote bug is in a second. What if I told you that if you could sell a short-term treasury paying 3.6% and you bought an agency bond that pays 5% and you went to investment income and your income dropped? You're like, what in the world? How could it drop? I should be crushing it on income here. Well, here is what happened. I would go into my income, and the total income which is visible there would actually be a lower number after I moved X from short-term treasuries to agency bonds. And to find that out, you have to scroll further down that same report, and you have to go to this area called fixed income. And if you scroll to the particular security you bought, sometimes you are going to see this data unavailable. Well, why is data unavailable? Because these securities have not yet settled. And so Schwab will not count your income until the security settles. And so if you buy an FHLB, for example, you could buy it on February 3rd, but it only settles on February 15th, or in this case, February 12th. Between February 3rd and February 12th, there will be no income shown on Schwab. So on the one hand, you're losing the 3.6% T-bill income, but on the other hand, you are not gaining the agency bond income, and that is why your income drops when you do that. What's another reason why your income is not exactly what you think it is? If you own T-bills, T-bills are considered cash, and so the T-bill gain is not part of income. They are part of your annual statement under gains, but they are not part of income. So if you sell something and buy a big chunk of T-bills, expect your income to go down and don't freak out. Well, I freaked out and then I figured that out. So my stock holdings, I have several still that are doing very nicely. With all the meltdown with software, I do have some volatility on the at the very top of the table, but I'm not a short-term trader. I like these stocks. I'm going to hang on to them. You do you. Please remember that even a broken clock is right twice a day. So don't trust me. Do your own homework. I would love to learn from you as well. Thank you and have a nice day.